Hi guys, this is Stanley.
And this is Willie.
Hi. We're gonna do our Facebook Live event again. So thank you for joining us. We have been doing our Facebook Live event for I think for like 7 or 8 months already, and yet we have discussed with so many other practitioners, and yet we never really check with ourselves before.
Yeah. Yes, indeed.
So this is the first time we have our very special guest, my co-founder, Willie Keng. A little bit about Willie. Willie is actually in the finance industry for a long time, and he has started his career as a fixed income specialist, first in Phillip Capital, and then he moved on to the private banking sector.
Correct.
Maybe you share with us a little bit about your
Sure.
background.
So from what Stanley said, I graduated as an engineering degree. And shortly after, I spent a very short time in Deutsche Bank doing sovereign risk analyst. So back then I was just helping out with a senior economist doing some financial modeling, not on companies, but on countries. And then after that, I moved on to a boutique fund, which is Phillip Capital Management, which Stanley talked about. That's where I started my first journey into bonds, corporate bonds in emerging markets, both Sing dollar and US dollar. Then after that, I found myself in the private banking space. I was working for 2 banks back then. One is in Bank of Singapore,
Right.
which is a wholly owned subsidiary of OCBC.
Yep.
And the latest stint after I quit and then joined Value Invest Asia is in DBS Private Bank. So I think DBS Private Bank was a more lustrous or more exciting position where I helped to actually set up a fixed income research platform with 2 other desk analysts back then.
Okay.
So it was quite an enjoyable experience.
Right.
So after that, I thought about it. I thought that corporate career is something which couldn't allow me to focus a lot on stocks. And hence I decided to make this move to join Stanley.
Right, you hear it.
Value Invest Asia.
Yeah, that's right. So actually, Willie used to be, I always say he's the corporate high flyer. But when we first started, we have 3 co-founders, but 2 of them were still working, and I was the first one who jumped into the ocean. But as you can see, after a year, Willie has decided to jump in the ocean with me. So now we have 2. And very happy that Willie is joining my team. So definitely we are doing something right, I think.
I was also inspired by Stanley as well.
Yeah, I think we have more people joining us. Hello, Mike and Augustine.
Hey, hi, Mike.
Welcome, you guys. If you have any question about dividend investing, about just fixed income, do share your thoughts with us. Just ask the question. We'll be definitely monitoring it on our phone here. And but before that, we were already asking questions through our Google form, and I think we have quite a number of good, interesting questions on that. Maybe before we jump into some of the good questions, maybe talk about dividend investing.
Sure.
How do you, what constitute a dividend portfolio in your mind, and what's a typical dividend stock like for you?
So I will basically address that with my first point. So as a corporate bonds analyst, there's this thing in the industry called carry.
Okay.
Meaning that if you buy a bond, some people, they just hold it to carry, meaning that they just clip the coupons. So you don't expect any form of capital appreciation.
Okay.
Because at the end of the day, the bond will mature after, say, 3 years or 5 years, depending on the maturity.
Okay.
So that's what a lot of people like to do. So they buy bonds for carry. And if we apply the same concept to a dividend portfolio, what happens is that you actually buy into a diversified basket of dividend stocks.
Okay.
And you buy it really for the carry itself. The same thing as a bond. So you buy it for the dividend yield.
For the yield itself, right.
Exactly.
And you hold it to perpetual?
So it really depends on, say, your valuation, on how comfortable you are with the stock itself. So unlike a bond where there is a maturity date, a dividend stock, you have to hold it to perpetuity.
Right.
Of course, you can always sell it. Whether you sell it at a capital gain or loss, that is another issue. But of course, it really depends on your risk profile, your comfort level, how how attuned you are, or how much time you're willing to spend in building this dividend portfolio.
Right. Okay. Okay. So okay. More guys are joining us. Hello, Benny. Hello, Philip.
Hello.
Yeah. And let's dive into some of the few questions that we have already sourced. Previously, Stephen was asking, how do you see the difference between, say, a dividend portfolio for someone who is already retired, or who's someone like us who is still actively working and we still have some cash flow from our work? Should that dividend portfolio be different? How would it be different?
Sure. So for the dividend portfolio, I'm actually helping to manage for my family, or I think more specifically for my mom.
Okay.
And
she's a retiree?
She's close to retiring.
Okay.
So she was just telling me that after a few years, after she funds for my sister's SMU education, and she says she will just call it quits from her job.
Okay.
So with that in mind, to build a retirement portfolio, it's very different because you have to assess the risk profile.
Right.
So for people like us, the ability to take risk, to absorb risk is definitely much higher.
Okay.
Say versus our parents, where sometimes all they want is to just get the cash flow,
right,
and to have stability. Stability meaning that you don't really want huge variations in prices in the portfolio.
Okay.
So if that's the case, then the difference is actually ranging from building how diversified the portfolio is. It can be as little as 20 stocks to up to 30 stocks.
Right.
And also finding the kind of dividend yield which you're looking at. So it can be for retirements, people who are going to retiree, they don't have to actually go for like 8+%. Sometimes when you have accumulated a decent capital base, what happens? Maybe you just need 4% or 5% dividend yield.
Right.
But that has to be backed by consistency, sustainability, and strong fundamentals of the company.
Okay. So you're saying that for retirees, they should err on the side of cautious, go after the more high quality, maybe blue chip dividend stocks, rather than for someone who is still working, you can go for a little bit crazier stuff like your Asian pay TV interest.
Oh gosh. So at the end of the day, it's not just looking for, like, you have hit the nail on the spot, right? It's not just looking for high dividend yield. You have to assess the underlying fundamentals as well.
Okay. Yeah, that's interesting. And I guess Karina was asking also, so if you talk about dividend and looking at the yield, how do you decide and how do you screen for, say, high dividend stocks and high dividend yielding REITs? So how do you see the two? Do you see them as the same?
High dividend yielding stocks
and REITs.
Yeah. So to address that first question which Stanley asked, I think both of them they have a blur line between the two. But one thing to note, maybe just to give a very surface analysis of both. So REITs, high dividend yielding REITs, typically dividends don't really grow that much. They don't grow organically because REITs, in order to expand their assets, they have to acquire. And in order to do so, you have to actually seek rights, or you have to borrow from the bank. So that could be a compromise to, say, unit holders, because when the rights issue comes in, you have to put in money.
Yep.
You can't grow organically because how a REIT is structured, I think everyone would be familiar by now. 90% of their distribution is paid off to unit holders as dividends.
Okay.
So you don't really get to keep cash to expand the business.
Yep.
Whereas for high dividend yielding stocks, so if we're looking at banks, utilities, property developers, a lot of them, they can actually grow organically. Right. So if you are buying, say, a dividend yielding stock, not a REIT, but a dividend yielding stock at, say, 4% or 5%, you can grow organically this because the earnings from the business can actually grow from reinvestment of their retained earnings, reinvestment from whatever revenue or profits which they have collected. So that's very different from a REIT.
Right.
So that's one thing which people out there, when you guys are constructing your portfolio, don't just look into
The
REITs,
yield,
but,
yeah, yield and
the yield, the REIT, but
Right.
of course to look into across the other sectors. as
Okay,
well.
I guess your point is REITs, because they have to pay out most of their earnings anyway, they are left with little cash flow to reinvest. Whereas a stock, even though it might be a high yielding stocks, maybe their payout ratio is not that high and they have money to reinvest in the business. I see. Okay. So maybe I ask for, say, your mom portfolio now. You don't have to say specific, how much you're investing, but the proportion, say the REITs, the investment between REITs and high yield stocks, what's the proportion there?
It's roughly about half,
Okay.
50-50.
Right.
Yeah. I think I'm indifferent as long as the valuation makes sense. I'm not overpaying for a particular stock. And if the yield makes sense for me, then of course I will buy. So I pay attention not just to REITs, but of course to the other sectors as well.
Yep. Okay. Wow. If you guys have any question for Willie, our fixed income and dividend specialist here, do just chat down below. We'll come to you every once in a while. I think let's take a question from the board, from the comment tab. Philip is asking, interest rate are increasing. I think this is a very popular question.
Yes,
interest rate is increasing, and it looks to be increasing anyway. And people are worried about REITs because as interest rate go up, the cost of running the REIT will be higher.
Yes.
So
correct.
how do you see that? Do you think REITs are well equipped for that, or are we going to see lower yield in the future?
I think the risk of rising interest rates on REITs itself, the impact is not so much on the borrowing cost, because if we see where capital values are right now, on average, it's roughly about 5% capitalization rate, meaning that how much rental income which the REIT earns over the current valuation or the property valuation is roughly about, say, 4%. The borrowing cost we are seeing across all REITs, I mean, if we do a simple average, it's roughly about 2.6, 2.7%.
I think they can't hear you. You must speak a little bit closer.
Okay, sure. Yeah. So maybe I'll just start. Off again.
On the REITs and the interest rate.
Yeah.
Right?
So the risk of rising interest rates on the REITs itself, it's not so much on the borrowing cost. It's not so much on the funding cost side, as opposed to their rental income. So why I'm saying this is this. So as rates go up, what you're seeing is borrowing costs would go up naturally. So that's the logical thinking. But the borrowing cost is still relatively cheap now, roughly about 2.5, 2.6%. So if you just take a simple average across all the REITs listed in Singapore, you'll find that how much they're borrowing at is roughly it's less than 3%.
Okay.
Versus the capital value. So they're actually paying out roughly about less than 3%. They're earning from their property, the capital value, so the capitalization rate is roughly about 4 to 5%. So capitalization rate meaning that the rental income divided by the property value. So that's roughly about 4-5% across, say, retail or commercial REITs.
Right. Okay.
The risk comes when, as rates go up, how I see it is really a function of an improving economy. But at the same time, you have some structural issues, meaning that retail, for example, we are seeing a shift from offline to online. And that actually results in a potential negative rental reversion for some of these malls. So what you're seeing, the risk here is really a fall in your rental income.
Right.
And when that happens, the REIT might not be able to produce very strong income producing assets at the end of the day. So while the borrowing cost is fixed at a low rate, but if your rental income starts to fall because of structural issues like your retail, or say there's an oversupply in your commercial space, then of course your rental yield will start to fall, and it could fall very close to how much you are paying out in terms of the borrowing cost.
Right, okay.
So that's how I actually see in terms of the risk.
Okay, so you can still invest in REIT, but you have to monitor closely its rental, I guess, reversion. Is it going up or is it going down?
Correct.
And as long as they are borrowing money, but they can get the yield higher than their borrowing rate, you are not that worried,
yes,
right?
Correct.
Okay, that's interesting. Okay, and Ignacio is asking, like, what about taxes? So for your dividend portfolio, do you invest mainly locally, or what about dividend stocks outside of Singapore? Some they get taxed, especially Chinese company. They have a 10% withholding tax on the company level, and also of course US and Europe they have like a 30% tax rate on dividend. So how do you look at that?
So currently the portfolio which I'm managing for my mom, it's mostly Asian stocks. There's a few bonds inside. I don't really look at the US because what we are seeing now, it's a huge bull market in the S&P 500. So naturally you are faced with a compression in dividend yield.
Okay.
US stocks are also subjected to a 30% withholding tax. So I have to consider the final dividend yield net of all taxes. And if that is below, say, 4 or 5%, it probably wouldn't interest me as much as if I can get something in Singapore or even in Hong Kong. Hong Kong withholding tax, yes, you're right. It's a 10% withholding tax on the company level. But when they distribute dividends to retail investors, it's actually 0%.
Yep.
The thing which I do have a few Hong Kong stocks as a dividend play. I think one of them is Chinese banks. And the risk which I see is on the foreign currency level.
Right.
So there could be a depreciation, say, the Hong Kong dollar against the Sing dollar.
Right.
So that's where that's where the risk which I typically tend to pay attention to.
Okay.
Other places which I do look at is also in Australia as well, but that's not as that's not a very frequent hunting ground for me.
Does Australia has a dividend tax as well?
Yes, it's so Australia has a 30% withholding tax.
Okay. Wow. Okay. That's interesting. But maybe I'll be a devil's advocate on this part.
Sure.
You're saying that for high. Let's talk about stocks now. For high dividend stocks, you want it to have a stable cash flow to sustain that dividend. But for a lot of US company, they do have that sustainable cash flow, just that they don't pay dividend.
Correct.
So let's say a company like Berkshire Hathaway.
Okay.
I do see it as an income stocks. Do you see it as something that you buy for a dividend portfolio?
So my thinking is slightly different from how you have thought about in terms of income. So how I think about income is a lot on whether there's actually actual cash flow coming to my bank account. Whereas for your definition of income is the earnings or the cash flow within the business accrues
sustainable
over time, but you don't get to see it's reflected in the share price, of course. So for me, that's where the difference comes in.
Right. And what do you think? What do you think my risk will be?
So you raised a very good point, Stanley. It sort of sparked the idea that for companies like Berkshire Hathaway, where rather than distributing dividends to shareholders, they believe that they are confident in reallocating their capital into the business, redeploying it, knowing that they can earn a much higher return on whatever investments they put out. So that's one way to think about it. The risk comes if the management did not promise what they actually said. So for companies like Berkshire, I mean, they have a consistent track record. So you know that if they redeploy their earnings rather than distributing dividends, they can grow the business. So you can see from the track record of an increasing book value in Berkshire Hathaway.
Yep.
But not all companies are like Berkshire Hathaway or Warren Buffett. So even though some companies, they don't pay out dividends, not necessarily they can actually build or accrue the kind of book value or the business expansion which Berkshire has. So sometimes in this case, it's better off for some of these companies to distribute the dividends to their shareholders. Number one, as a sign of confidence. And number two, at least you have a bird in your hand rather than having that bird in the bush.
Yeah. So basically, you're saying that unless the management is Warren Buffett and you know that he's gonna reinvest it better than you, so you rather you pay me back. I trust myself more than you. Okay. Yeah. On that point, right? Especially when we are looking for company that is paying dividend to us, how can we know the warning signs? Like, oh, look at this company has a very high yield now. How can we assess the risk, and how can we avoid things like your Asian pay TV trust, this kind of thing where they have more than 10% dividend yields? It looks very attractive, and yet clearly it's not sustainable. Where is the point that you look at to spot all this, I guess, yellow flag or red flags?
I think very simple. Number one, you can look at the historical price movement. Number one, see where they actually IPO'd the company, and then make a guess at a point in time when they did the IPO, is it at a very high valuation? Because if it is, there's a good chance that they're selling to the retail market or to investors like us at a very high price. And for us to actually buy the high price, there's a good chance where you will see capital depreciation or capital losses on the stock. Number two, how we actually identify is, of course, the business mode or the economic mode, which Stanley, you yourself have actually talked about in some of your previous workshops as well. So to actually identify the strength in some of these companies' modes, one company which I have, which actually saw capital losses over the past 2 years, was M1. So I'm pretty sure for dividend yield players, I think...
I'm sorry for your loss.
Yeah, so that was actually one of the stock which actually came down quite aggressively because of higher competition. And you have asked me how to identify some of these stocks where it could actually be potentially warning signs. And one of them is a deterioration in their moat.
Right.
So like the three telcos, Singtel still has it's still an incumbent position, but M1, you're just a pure play postpaid
afterthought.
and Singapore is also trying to open up the telco market as well. So that's actually one of the warning signs which we see, a deterioration in the mode itself.
Right. But have you sell M1?
So I'm not sold it yet because I thought that the dividend which I got is still reasonable.
Okay.
Plus, it's still a small position in my portfolio.
Right. Okay.
I'm still holding on to it.
Plus, you told me that even because you bought it at a good valuation, all the dividends actually make up for your losses, right?
Yeah.
So you want explain that a little bit?
I bought M1 in 2015 when the price was still about $2.70.
Okay.
And then I think it was paying a healthy yield of about 7+%.
Wow. Okay.
Right now I'm seeing unrealized losses about 25-27%. But the interesting thing is when I was looking at the Excel spreadsheet, my total return is still positive. I mean, it was only a positive 1.7%.
Okay.
But what I realized is that with a dividend portfolio, the cash flow which you get from the dividend actually helps to mitigate the kind of price loss which you have. So it helps to reduce the purchasing cost of the stock.
Right. Okay. So that's one way to look at it. Having a good dividends counter that is the dividend is still sustainable, and not focus too much on the share price because the dividend is continuously coming.
Yeah.
And how do you build up the portfolio? You talk about just now before we start. You talk about how you use the cash flow on the dividend itself to reinvest maybe in other companies. Maybe you share that strategy again with our audience.
So for a dividend portfolio, how I do it is think of it from the back. So look at it from your endpoint. Think about how many stocks you want to actually own or diversify. And then think about the sector's distribution. So like I mentioned, it doesn't have to just be solely in REITs. It can be across other sectors.
Right.
And then think about diversification. I think that's the most important thing about building a dividend portfolio, because what you want is not huge, crazy upsides, which can potentially become multi-baggers. But what you want is really safety of your initial principal. You're looking for okay growth on the business, and the dividend has to be consistent. So you look at roughly 25 to 30 stocks in the portfolio. So not one stock is more than 5% of the portfolio. And this 5%, why I say this is why a 5% is because on average, the dividend yield which you would most likely look at in this kind of environment is roughly more than 5, so between 5 to 7%. Example, if a stock which you buy happens to go down or defaults, goes all the way down to 0, at least that 5% which you earn for that year would sort of offset one of the losses which
one
you have.
default.
Yeah. Or if let's say if you have two stocks and both stocks are down 50%, you have at least a decent dividend yield, a cash flow yield to offset some of these losses across the portfolio.
So you're basically saying that if you buy dividend stocks, don't expect like super high multi-baggers from it, but rather think of it on the safety point of view first, right? Which one will protect your capital, give you a decent return. But say, I think Yao Shen asked a good question, which is, what should be our expectation? You know, when we buy dividend stocks or be a dividend investor, what's the expectation return that we should be thinking about? You know, what do you think about that?
Sure. So for dividend portfolio, expected return is, I think Yao Sheng raised a very good point. Expected return is something which is very individual to all of us. So while you might have an expected return of say 100, 200% on the stock, for a dividend portfolio or dividend stock, when I'm looking for expected return, it typically does not go above 100%. What I'm looking for is say 7%, 6 to 7% on my dividend alone. On my capital gains, maybe I can go about 30 to 40%.
How long is that period?
So that could take about, say, 4 years. A period of 3 to 5 years.
Right.
Average about 4 years.
Okay.
So the portfolio which I started was roughly in 2015. On average, I would say the return so far, the total return so far has been decent. It's roughly about 30, 40%. So I mean, you have the extreme cases where I have stocks which goes down to below losses of 20 to 30%, which is my M1. And then you have banks which I've bought, which actually went close to double or 100%. But your expected return for
the whole
stocks,
range,
typically shouldn't be that aggressive. Because as you get too aggressive in your upside, you tend to actually fall into traps.
Going for the too high risk stuff. So I guess on an annual basis, you're I just did a mental calculation. You're looking at roughly, slightly less than 10% a year. That kind of return from a decent dividend stocks, right? Okay. That's still quite aggressive to me, I think. But okay. Ming Jie is asking, when you manage your portfolio, do you reinvest all your dividends, or how do you look at it?
So currently, I'm still holding some cash on the portfolio. It's all commingled together with the existing cash. So I wouldn't necessarily say that I'm reinvesting all the dividend cash flow. What is going to happen, or how I'm going to plan it, is as I draw down as I continue to draw down the existing cash on my portfolio, what's left on my dividends, how I'll reinvest it is probably more dividend yielding stocks. So I'll let the dividend yield compound
by itself, right?
For me, because the portfolio's risk profile is not of a high risk, like one of the questions was asked, the difference between a retirement portfolio and a portfolio which is held by an actively employed person. So this portfolio which I'm managing is actually more towards the retirement side, and I don't really need very high risk adjusted returns, but rather it's probably more safe, sustainable dividend yielding stocks.
Okay. But when you say you redeploy it, do you buy back the same stocks, or you would always look for another new company to buy?
So I try to make sure that each position is sized correctly, meaning that it's not more than 5%.
Mm.
If there are some stocks, existing stocks, which I'm holding,
Mm-hmm.
is less than 5% of my portfolio, then I will actually top it up or reinvest into existing stocks.
Right.
Otherwise, I will actually look for other
New
stocks
stocks.
or other securities to buy into.
Okay, interesting. Wow. But I think today you told me that you have actually 2 case study to share with us.
Sure.
Right? Let's dive right into it, because I think a few of our viewers is also asking for, what are you buying? Right?
Yeah.
Of course, these are not stock recommendation, but just as a case study.
Correct.
What's the 2 stock you want to talk about that you recently invested in?
All right. I think I'm seeing also Brandon, who was asking about any hot tips.
No
Hello,
hot tips.
Brandon. Hello, Brandon. So there's no hot tips, but what I'll share with you are some of the case study. One of them is actually Bank of China.
Okay.
This is a stock which I've currently holding.
So listed in Hong Kong.
Listed in Hong Kong. It actually reflects a dividend yield of roughly 6%.
Okay.
So how I see it is, I look at it from number one, a business angle. So I think that Bank of China, together with the other big 4 banks, are an incumbent position.
Right.
So they have a very strong deposit franchise. Because of that, they actually have very low funding costs.
Right.
So the thing about banks is this: it's not really about how fast they grow their lending book, or not just how well they manage their risk, but it's also how they manage their borrowing costs.
Right.
What I think is that the lowest funding cost for banks ultimately will win, because with a low borrowing cost, I can actually be more flexible in who I can lend out to. Versus say a bank which has a very high borrowing cost, right? If let's say if I have a low borrowing cost, I don't have to lend out to very high risk borrowers in order to earn my net margins. I could always lend out to strong companies where the borrowing costs, where their borrowing rate is much lower, and I can still make a profit.
I see.
So that's how I actually look at from a bank standpoint. So it's very easy. You just have to look at it. It's all about practice. You look at the financial statements, you look at the assets, and then you come to a point where you think about the valuation.
Right.
The valuation is one of the critical criteria which I tend to pay attention to. It's as important as finding out what the mode of the business is. So Bank of China, when I bought it, is roughly about 0.6 times price to book value.
Price to book, right.
So that is it's quite a wide discount to book value.
How much is say DBS at now?
I think DBS is roughly about 1 times.
1 times book.
Yeah.
Okay.
So it really depends on your risk profile, what sort of yield you are looking for. So for me, I typically tend to target around 6%. I think that's a decent amount, considering interest rates are increasing. You have your 10-year yield, your US Treasuries 10-year going up above 3%. So asking for a 6% dividend yield on my stock portfolio, I think it's a reasonable approximation for me.
Right.
And Bank of China comes into play as one of the potential candidate, and that's how it fit into my portfolio.
I see. Okay.
Yeah.
But why do you choose it over, say, the other 4 banks?
I think Bank of China, it's more aggressive in their international exposure.
Okay.
So that sort of helps to mitigate against the domestic business.
Right. Okay.
So you have Bank of China. I mean, there are the other 2 banks like China Construction Bank and ICBC. They are also starting to go into the international markets. But Bank of China has been the first mover, so they have actually moved out. And about 10% of their income, operating income, it's actually already in overseas.
Right.
So that sort of helps to mitigate the business.
Right. Mike actually asked, is Bank of China Hong Kong? Because when you look at the listed stock Bank of China, there's actually 2. One is Bank of China Hong Kong, and one is Bank of China.
Correct.
Can you talk about the relationship?
Yeah. So Bank of China Hong Kong. Okay. So there's 2 listings. So I'll address the listing first. Bank of China is dual listed. So you have the A share market, you have the H share market. In terms of the operations, so you have BOC Hong Kong. BOC Hong Kong primarily takes care of the international business.
Right. Okay.
So the loan book or the assets versus the Bank of China domestic entity is actually much stronger.
Right.
If you compare the loans and the assets. But that's not to say that overall Bank of China's assets are weak. It just so means that BOC Hong Kong is actually much better capitalized.
Okay.
Has a higher asset quality. I think also because of the geography, the demographics, the profile of the loans itself.
Right.
The businesses which Bank of China typically lends out to in the international market tends to have a much higher quality.
Right. So Bank of China Hong Kong is basically a listed subsidiary of Bank of China, right? And because they have two listings, you're able to see how their domestic business is doing compared to their international business. Okay. Before we go on to stock number 2, I just want to let you guys know that this Facebook Live is actually sponsored by FSMone. It's a discount broker in Singapore and offering one of the lowest price brokerage. And we do regular workshop with them as well. And in the last workshop, they also talk about, because they share their ideas and they have tons of research. If you're a member, you can get connected to their research report, and they are also talking about the China banks, of how they feel that is attractive right now, and they offer different instruments such as maybe ETF to gain access to them. So if you are looking for a good discount broker, do check out FSMone. You can just go to their website, fsmone.com. Right. And now stock number 2, Willie. No pressure, you know. But you know, normally the second one will be better than the first one.
Let's hope so, right?
So what's the stock number 2 that you recently bought?
So this is not something which I have recently bought yet, but it's something which I'm looking at. It's a company listed in Singapore. It's a property developer called Yanlot Group. So it's a mid-sized developer. This is slightly more aggressive versus Bank of China. More aggressive in a sense where the sector which they are in, the position they are in, might not be as strong or as solid as Bank of China itself. So you're comparing an incumbent financial institution versus, say, a top 50 or top 100 player in the Chinese property market.
Right. Okay.
So Yanlot Group is a company or a stock which I was looking at. So it was yielding at about 5.
So this one listed in Singapore, right?
Yes, it's listed in Singapore. Yes, the dividend yield of about 5.4%.
Okay.
The valuation right now on the price to book it has actually dropped from I think 0.8 to about 0.5 times.
Right. Okay.
So it has a market capitalization of 2.2 billion. Shareholders' equity, which is an approximation of its book value, is roughly about 4.2, 4.3 billion. So it's about 0.5 times price to book.
Okay.
And how I see it is, I look at it from a macroeconomic standpoint. There is right now a lot of fear in the Chinese property market where there's a risk where property developers will not be able to refinance a lot of their offshore dollar borrowings. So offshore dollar borrowings means that this developer situated in China has bonds which are being raised in the dollar market, meaning that they have US dollar denominated bonds. And the risk comes when these bonds gets more expensive and results in some of these developers unable to refinance themselves.
Right.
How I see Yanlot is because they have been in Singapore, they have been in business since the 1990s. They have actually worked with the Singapore government before in some projects, like Sembcorp, for example. They even have some of their Sino-Singapore JVs in Tianjin as well. So they have some ties with the government. On top of that, they have a very specific niche in the property market.
How so?
Unlike a lot of Chinese developers where they develop a lot of residential, mid-tier or high-tier residential properties, Yanlot, they go for the highest.
Right.
In what you call in Singlish is atas. So very high premium kind of property projects. And that results them carving out a niche for themselves. So they have very strong margins for these projects. So property, I typically look at their gross margins.
Okay.
So their gross margins is roughly about 40-45%.
Okay.
Versus the other Chinese developers were typically ranged about 25 to 30%.
Okay.
So when I think about their business, even though they might not be the incumbent property companies in China, but they have a niche for themselves. And for me, how I think of that is that for them, with that niche and with the ability to be able to develop high margin business, I think they will be able to refinance their borrowings or their debt based on the cash flow which they receive from a lot of their property projects.
Right. Okay. But their debt, how's their debt level like? You're not worried. You're not too much worried about it.
So for property developers is this. I'll just give you a short tip or short advice when we look at property developers. Don't just look at 1 year alone or 2 years. Look at them from a 5 years or up to a 10 years historical standpoint. And the reason why I'm saying this is because developers, they move in cycles.
Okay.
So on some years they will have very high leverage. On some years they're very low.
Okay.
But you have to find out how they actively use this borrowing for their projects. There are some developers out there. I think our audience also would know that some of the Singapore developers, they are always perpetually in debt.
You want to name names?
I think I'll not name names, but
if you check out our website, you'll know which one we're talking about.
But I can share with you all when we do our next workshop in December.
Okay.
So Yanlot has actually been a very astute user of borrowing. So they know when to actually build up their leverage and they know when to deleverage themselves. At one point, after they cleared their major projects, I think it was in 2014 or 2015, I think their leverage dropped to, on a net debt to equity basis, I think it dropped to less than 10% or less than 20%.
Really?
Right now, I think it's more than 100%, which I still feel comfortable with because their track record reflects that they are a niche player in a very high premium, high tier residential development market.
Okay. But okay, because when you talk about property development, of course, especially in China, there's such a competitive space. How do you compare them to, say, those listed in Hong Kong or even some of the larger ones, say your Country Garden or your China Vanke? I think they are trading quite similar in valuation. Why do you end up with Yanlot?
Yeah, so I think Yanlot is easier to track. In a sense where it's easier to track their projects because they're not very big. Country Garden, Evergrande, China Vanke, yes, they're huge.
10,000 projects.
Yeah, they have so many projects. It's so hard to track each one of them. And if we pay attention closer to their margins, it's actually not as strong as Yanlot itself.
Yeah.
But of course, the reason why, and comparing your valuation, I think Yanlot trades at a slightly higher discount to the bigger developers. I think because of their natural large sizes, a lot of the money which is being deployed by, say, institutional managers, they typically tend to go to the big players.
And also ETF, right?
Exactly. So that's where sometimes companies like Yanlot, they tend to be what I call a lost child. They don't really they are not really favored by the market, and that's where people like both of us, actually go in.
Okay, but what do you see will be the catalyst here? Or you're just there just for the dividend, 5%, that's good enough for you. But for, listening to how your expectation, you're not just looking at the dividend, right?
Correct.
So what's the catalyst you're waiting for here?
So when I mentioned about Yanlot, it's slightly a more high risk. A more high risk play. So depending on how you structure your portfolio, you can have a bit of some of these high risk stocks. How I see the valuation is this. I think that dividend yield, if the price still stays at this level, I can actually clip say a 5% dividend yield annually, which is fine. I'm also looking at the capital appreciation. So since trading about 0.5 times, and historically it has been trading about 0.7, 0.8 times.
Okay.
I will probably get a decent capital upside, say about 20-30%. And that is something which I'm actually comfortable with.
Right.
Because this also allows me to offset my foreign exchange risk. Because don't forget, if we are Sing dollar investors and we invest in Hong Kong stocks, there might be a chance where your Hong Kong dollar or the US dollar might actually depreciate against the Sing dollar. So capital appreciation sometimes help to offset this part of the risk.
Okay, wow, cool. That's a lot for you guys to think about. But just to add to the confusion, maybe you can see if you guys have been following us for a long time, you will realize that the investment style of me and Willie is slightly different.
Yes.
I would say that I agree with his analysis of Bank of China, the main stock, Bank of China, which is the one that he invested in, and I also invested in. But I'm not so sure about Yanlot yet.
I think we can have another Facebook face-off.
So that's just to mess with your mind a little bit. But that's it all from us. Thank you so much, Willie. But before we go, if they want to know more about dividend investing, I believe you have a workshop coming up.
Yes.
Why don't you talk a little bit about that?
Yeah, sure. So we have a workshop coming up in December. It'll be on
the 3rd on December,
3rd of December. So it will be called Dividends Don't Lie. So for anyone who wants to actually find out more about how to build a dividend portfolio, how I actually go about looking at dividend stocks, not just REITs alone, feel free to drop by if you guys are not overseas for a holiday. I'll be there to just share with everyone how you guys can actually augment or support your accumulation of wealth via dividends.
Right, that's interesting. I will be the first to sign up, right? Okay. But that's it from us. Do check out our Facebook page, and also if you're on our mailing list, you'll get invitation to that workshop coming up on the 3rd of December. And before we go, just another shout out to our sponsor, FSMone.com. I have used a lot of brokerage, and I have to say they are one of the ones that really helps integrate all my portfolio together. And I only have good things to say about them. So if you're looking for a more reliable broker, so you're not that comfortable with your brokerage right now, do check out FSMone.com. That's it from us. Till next time. See you guys.